Inflation may be cooling down, but interest rates are still at record highs. So why isn't your wallet feeling any better? In today's video, we're going to explain why inflation and interest rates are so tightly connected, and why the Federal Reserve's decision to raise rates is still affecting your finances. In 2024, let's start with the basics. Inflation is the rise in the price of goods and services over time. Over the past couple of years, we've seen inflation soar to levels not seen in decades. This was due to a combination of factors: supply, chain disruptions, increased consumer demand after the pandemic, and even the war in Ukraine affecting energy prices. Inflation is measured using the Consumer Price Index (CPI), which tracks price increases across everyday expenses like food, gas, and housing. The goal for the Fed is to keep inflation at around 2% annually, a level that fosters economic growth while avoiding runaway prices. But if inflation is slowing down, why are interest rates still so high? Shouldn't we be seeing a break? Interest rates are the Federal Reserve's primary tool for controlling inflation. When inflation is high, the Fed raises interest rates to make borrowing more expensive. This slows down spending and borrowing by businesses and consumers, which cools demand and helps reduce price pressures. But raising interest rates also has its consequences. It makes things like home loans, car loans, and credit card interest more expensive. So even though inflation may be slowing, the cost of borrowing remains high, impacting everything from mortgages to business investments. Now here's where it gets interesting. Why aren't interest rates falling back down? If inflation is cooling, here's the crucial thing to understand. The effects of interest rate hikes don't happen overnight. It can take several months, sometimes even more than a year, for the full impact to be felt in the economy. So even though inflation is slowing, the Fed is reluctant to cut rates too soon. If they do, they risk inflation rising again, which could destabilize the economy. So, what should you do in this environment of high interest rates? The first step is to focus on reducing variable rate debt like credit cards or adjustable rate loans, since those are most directly affected by rate hikes. If you're planning on taking out a loan, it's smart to lock in a fixed rate loan now, before rates rise even further. Understanding the relationship between inflation and interest rates can be tricky, but staying informed is your best weapon. Hit that subscribe button to keep up with the latest updates and learn more about how to protect your finances in a high-interest world.